So impact investing, that has grown. It is definitely reshaping the financial markets. So we're going to look into what the trends are and the opportunities around impact investing and how we can really try to make it more mainstream. So to get the conversation started, let's take a look at this.
There is a pressing need to act to address social and environmental challenges. The latest IPCC report stressed the dramatic and sometimes irreversible impact of global warming. Last year, the World Bank predicted that COVID would push close to 150 million people into extreme poverty by 2021. The goals of impact investing is to generate positive impact while at the same time delivering commercial financial returns. We invest today with tomorrow in mind. Our overall goal for social impact investing is to serve the underserved. It's about providing critical services and improving livelihood of low-income population. 2 years ago, we launched ABC World together with the Temasek Trust. That was our first foray into impact investing.
ABC World Asia is a private equity fund dedicated to impact investing. We seek to invest in innovative companies that can drive positive change at scale. When we formulated our strategy, we found Asia faces many challenges. Climate change, rising income inequality, overcrowded urban spaces, just to name a few. On top of that, Asia is very underserved. Asia has 60% of the world population, but it only receives 14% of the impact dollars. To address this gap, we identified 5 impact investment themes: financial and digital inclusion, affordable healthcare and education, climate and water solution, sustainable food and agriculture, and smart and livable cities.
In 2021, we closed our investment in LeapFrog, thereby cementing a very strategic 500 million partnership with the leading impact-first fund managers in emerging markets.
Impact has now grown to something that is close to $1 trillion as an industry that is really reshaping financial markets. And what we are determined to do together is to lead this industry. LeapFrog on its own aims to reach, through its companies, 1 billion low-income emerging consumers with healthcare, with wealth services, and with other essential services that enable those people to rise. And that is our ultimate mission, to open the gates of the capital markets to purpose-driven businesses that help end poverty and empower people on an unprecedented scale.
And beyond these 2 partnerships, we will also invest in other impact funds, continue exploring co-investments and direct investment opportunities to deepen our impact. There is one quote I'd like to share with you, and that is one that has really been very important to me. It's in the book written by Ronald Cohen, Impact, Reshaping Capitalism. He compares impact investing with a chain reaction. We're all part of the chain, and government, private capital, public capital, entrepreneur, NGOs, DFIs have to work together as part of the same chain. It grows exponentially. The more interaction you have, the bigger the reaction. I find this quite enlightening, and we effectively want our capital at Temasek to be a catalyst for that reaction. To achieve impact, we will continue doing what we know well, investing today with tomorrow in mind. So today we are honored to have with us on the panel our friends and partners. We have Ruth from the IFC, who connects public sector and private sector to channel more capital to impact investing. We have Andy, my partner in crime, from LeapFrog, who's been pioneering impact investing for the last 15 years ago. David, my friend and colleague from Temasek, who joined ABC to create and bringing forward impact revolution in the region. And Amit from the GIIN, who will moderate the panel. He has created the GIIN, and the GIIN has paved the way for the massive growth and acceleration of the impact investing industry. Sir Ronald Cohen, which I've quoted before, known as the father of social investment, unfortunately cannot be with us today. He will share a closing remark towards the end of this discussion. With no further ado, I look forward very much to our conversation today. Thank you very much.
Good evening, everyone, and good afternoon and good morning to our global audience. I'm incredibly honored to be here at such a special week that's been convened by Temasek and its partners around ecosperity. And I also have the privilege and the dual honor of both leading the Global Impact Investing Network and of moderating this important session tonight. You know, ecosperity has had an incredible program over the course of this week, you know, tackling big issues like climate action and the need to protect our natural systems. One of the common threads throughout the entire agenda has been this: we cannot have a sustainable world without changing the way the world invests. We need to invest in turning the tide on climate change. We need to invest in thriving ecosystems. We need to invest in a sustainable and inclusive society. And that need brings us to the focus of this panel, and on its focus on the idea of an impact revolution. Now, when we say impact revolution, we're referring to a couple of transformative events that have really changed the global economy: the Industrial Revolution, the IT revolution, the digital revolution, and now the impact revolution. From the GIIN's perspective, our vision is for a world where impact becomes part of all investing, where we actually shift the way we think about fundamentals to include impact, things like value, risk, fiduciary duty, and performance. You know, where impact becomes part of the new operating system, just the new business as usual. Now, we have a long ways to go to get from here to there, and it's an incredibly tall order. But the focus of this panel on impact investing is really critical to that vision, because impact investing by design is putting impact at the center of the way investors are allocating capital. We've had conversations throughout this week around how to reduce the harm and negative impacts of investments, of how to manage and integrate ESG from a risk standpoint. And impact investing builds on those themes and looks specifically at how do you allocate capital for a positive impact? How do you allocate capital into solution areas? Things like sustainable agriculture, sustainable forestry, clean energy, financial inclusion, access to basic services like healthcare and education. And I'm so privileged to be moderating a panel with some great leaders and thinkers and investors on this topic. And we'll dive into the session in just a moment, but I do want to acknowledge the fact that we have a hybrid format. We have an intercontinental panel with people, of course, here in Singapore, but also dialing in from Europe and Australia. And we'll do our best to make this as seamless as possible. We will also be taking in questions from the audience, and so please use the platform to feed in your questions. We've got a lot of ground to cover, but I certainly hope that we can work in some of the ideas and the things that are on your mind. So please take advantage of the platform to let us know what you'd like to hear from the panel. But now to kick off, we'll start with just an introductory question around, and I'll ask each panelist to talk about how do you approach impact investing? You know, what is your organization's strategy when it comes to impact investing? And Benoit, I'd love to invite you to kick us off.
Hello, everyone. So Benoit Valentin, you heard me on the video, so trying not to repeat what was said during the video. I've been an investor for 21 years. I joined Temasek 7 years ago to help lead the EMEA effort. I'm head of fund investing, private equity fund investing, and since last year, head of impact investing. And I think there is two key reasons why Temasek came to impact investing. One is there is a great alignment of values and purpose between what Temasek is about and what sort of impact investing is about. We are a generational investor, so we invest today with tomorrow in mind, which means that we view it as our fiduciary duties for the future generation to do good in order to do right and well. And we're absolutely convinced, as was said by the German Lim on the video, that unless we sort of preserve the environment, maintain the social fabric, bridge the social divide, the world as we live in and the system as we've enjoyed it will not sustain. And in other words, we believe that our mandate goes far beyond generating pure financial returns. And if you think about it, that's the raison d'etre of impact investing. So that's about the alignment. And if you allow me, there is some historical perspective I'd like to share with you, which I think is enlightening. When it comes to the very foundation of Singapore. If you read the book, and I think many of us have read the book of Lee Kuan Yew about the third world to first, where he effectively goes through the challenges he had to address to build a nation in Singapore. There are two chapters which are very interesting. One is called Greening Singapore, and the other one is Building a Fair, not a Welfare Society. And it's very interesting that at the very beginning of the foundation of Singapore, maintaining the social fabric, bridging the ethnic divide, and preserving the environment were actually seen and viewed as conditions to building a sustainable Singapore, not afterthoughts, but really preconditions. And we're very much in the same place today. So that's the first thing, is very strong alignment. And then there is obviously, like we've seen and we all agree, there is a criticality in terms of timing. We need to act now. 2 years ago, we got together the management committee of Temasek to really think about what should be our sustainability journey. And we've laid out many different pillars and foundation of that journey, including ESG, carbon capture, and others. And impact investing was one of that pillar. And then COVID hit. We accelerated our thinking. We defined our strategy. Today we have one team, one allocation, and one clear strategy. So just trying not to repeat what was said during on the video, but effectively is one, serving the underserved. Even though we view impact for communities and impact for climate as equally important and time critical, the impact investing team, as is set at Temasek, is really focusing first on social imbalances. And on the side we have, and you heard the number of initiatives we had on the decarbonization side. So, but serving the underserved is the critical focal point for us, and which frankly has also been guided by the impact of COVID. Then is supporting the practitioners. There are plenty of practitioners on the ground. These guys have been the pioneers of impact investing, and we want to support them. And number three is we didn't want to be just an LP in that ecosystem. We really want to be an actor. Hence the foundation of ABC World, kind of 2.5 years ago, and the strategic partnership with LeapFrog. So these will be the two core pillars of a strategy impact investing. And alongside these two core pillars, we will invest in other funds as an LP, funds which will prioritize serving the underserved, so primarily emerging markets, and which will combine the intentionality and the track record.
Great, thank you, Benoit. I want to pick up, we'll come back to some of those topics that you raised, but Andy, we'll go to you next. Can you talk about how LeapFrog approaches impact investing?
Well, I founded LeapFrog in January 2007, before there was a term impact investing or a GIIN. And it was because I saw this guy, Steve Jobs, 3 weeks before I left my job to start LeapFrog, launch the iPhone. And I saw that 4 billion people essentially were going to join the grid, were going to join the global economy. And those people, instead of being off the grid and being thought of as poor and inaccessible, were going to be emerging consumers and emerging producers. And we set out to create a dedicated pool of capital focused on the businesses serving those emerging consumers and producers. So LeapFrog is a private equity group. We launched with President Clinton nearly 15 years ago. He and I, at that moment, set out to raise $100 million, reach 25 million low-income people, and generate top-tier private equity returns. And we said we would do this as LeapFrog by the end of the decade. And so now at the end of the decade has just passed, and you can hold us accountable. Today, LeapFrog has had over $2 billion of commitments. Our companies reach over 221 million people, and those companies have grown at 26% a year on average. So we believe that private equity investment in companies that are purposive, that serve those emerging consumers and producers well, can generate significant outperformance. And I think the way that we think about impact investing is that you need to be investors through and through. Every member of the team needs to be a dedicated impact investor, such that there is intentionality in everything you do as a company, right from considering what you invest in, how you go about it, monitoring and measuring it, and even in our responsible exits framework and the ways in which we engage with our limited partners.
Great, thanks, Andy. And now Ruth, will turn to you.
Sure. So IFC Asset Management Company is part of IFC. So as a result, we are impact investors by DNA and by definition. IFC has the goals of reducing poverty and increasing shared prosperity, and every investment IFC makes must have impact as well as return. And what we do is a subset of those investments. We were founded in 2009 under the assumption that there was more capital out there that wanted to go into investing in emerging markets. And yes, we didn't call it impact then, just like Andy mentioned, but did want to make a return and maybe do some good at the same time. And we have been out there doing that. And every investment we do, again, is thought through from its initial concept all the way through its exit and its management on what is the impact, how can we measure it, what are we doing, where are we going with it, why are we doing it. And we find that that really is a great structure because it also helps in some cases to de-risk investments in emerging markets, because when you have managements not only thinking about financial returns and growing the company, but also thinking about how their employees are impacted and how they're impacting the community, you can actually look at an investment cycle overall and say that might be just a bit less risky than just going in straight.
Great, thank you. And now, David, can you talk a little bit about how ABC World is approaching impact investing?
Sure. I think your question, how do I get into impact investing as well, right? So I recall, I think that's back in July 2018. I got a call from Hock Kwan, CEO of Temasek Trust. She asked me to think about setting up an impact fund. I was quite intrigued at that time. I just stepped down from Temasek after spending 25 years in the finance industry, 15 of which in Temasek. So I rang a few people, I went to Paris, attended the GIIN conference, and then I managed to recruit two of my ex-colleagues, Sugandhi and Xiaoming, to join me on this new journey. So on the personal side, I think I'm also a very keen scuba diver. So I've seen the effect of climate change on the coral reef, as well as the terrible plastic pollution in our ocean. So I think that sort of drive me to try to do the right thing. So that's how I started. Right. For ABC World Asia, we are a baby compared to Ruth and Andy. We just started back in 2019. Our approach, we based on Temasek's vision of ABC World. ABC World is a term coined by Ho Cheng. I'm sure you guys know what's ABC World all about. It's active economy, beautiful society, clean earth, right? And ABC World directly corresponding to the 17th SDG. That sort of formed the backbone of our impact approach. We aim to generate market return alongside a measurable return on society as well as the environment. We understand that there's a lot of greenwashing around. So we want to make sure that the output of businesses, the linkage to the targeted outcome, we want it to be evidence-based. Not the easiest, but I think we just want to make sure that we hold ourselves to that bar. Right? In terms of geographical approach, we are in Singapore. Clearly, I think our focus is in Singapore. And our team intimately know Asia well. And then we have the support of Temasek and our family here. So I think we do have that advantage. And also I think Asia, as I said earlier in the video, we are very underserved, right? And so, if it's underserved, there are plenty of opportunity. In terms of what type of investment, company we invest in, because our framework is actually more targeted towards growth. Yeah, because we need the materiality, we need how much, we need the scale. So I think, not surprisingly, in terms of the split between growth as well as and venture, is about 80-20. But we see that changing. We are seeing more venture deal now. That portion will go up, I think, as evident in our pipeline. In terms of governance, we are an active investor. We seek board representation to align our impact goal with the company. Impact investing is still very, very new in Asia. So it's a short summary of what we are doing. Thank you.
Great, thank you. And I want to pick up on one of the themes that Benoit actually mentioned around how Temasek sees its fiduciary duty. And one of the things that we see all around the world, the GIIN has members in 52 countries, spread across 6 continents, and wherever I go, the question always comes up, is impact investing commercially viable? Is it appropriate for my portfolio as a fiduciary? And Andy, this is obviously something you've been encountering for a long time as well through your journey. And I wanted you to speak a little bit to the commerciality of impact investments. How do you see it from a return perspective? And how do you see LPs and partners that you work with just kind of process the opportunities in impact investing from that commercial dimension?
Well, it's a great question, Amit, because it's hard to describe just how weird we all were thought to be all that time ago and when you were starting the GIIN with this idea that you could generate returns from doing good. There was a notion at the time that there was no trade-off. But the no trade-off argument is quite weak because you're asking fiduciaries to go into an area that they don't know very well and then telling them they can get the same returns and risk adjustment. Now, what LeapFrog set out to say was that there was profit with purpose. In other words, there's a synergy between doing well and doing good, that you can achieve outsized returns by achieving outsized impact and vice versa. And the important thing of this journey of the past 15 years has been to see that demonstrated across multiple funds and investments, not only by us, but by a number of pioneering groups around the world. And when we launched LeapFrog, we said there should be 100 LeapFrogs. There are now hundreds and hundreds and hundreds of managers, and the data set has got larger and larger. And what the studies are showing by the likes of Cambridge Associates is that, in fact, impact can be an outperforming strategy. Now, of course, not every impact player outperforms. Not every impact player is built to outperform. But there's no doubt, as you see mega private equity groups and other groups entering the space, that they're not coming only for impact. They're also becoming because they believe they can fulfill their fiduciary obligations to get outsized returns along with their outsized impact. And the reality is, if you think about it, it's intuitively quite plausible. We've just grown up in a world where doing well and doing good are kept separate. But fundamentally, profit meets purpose at the customer. In the end, if someone is being a low-income person getting an essential service, they are part of the revenue line. If you serve millions of them, there's going to be more revenue and ultimately more profit, and more people in need are going to be served. So in fact, if you think about the intuitive role of business and investment, it's to draw the line back from that customer right through to the limited partners who are investing. And that's why we talk about profit with purpose cascading all the way through. The red thread that cascades all the way through is that you need the synergy at every single level to be understood. And that requires things like transparency and very powerful demonstration effects that I'm sure we'll discuss tonight.
Oh, great, thanks, Andy. And I'll move to another dimension of performance that's so critical when it comes to impact investing. There's the financial performance and there's the impact performance. We do a lot of work, including with all of my fellow panelists, on impact measurement and management at the GIIN. And this is an area where there's now a lot of mainstream investors trying to understand their impact and trying to measure their impact across a number of dimensions. I'm going to ask our panelists to talk a little bit about how they think about impact measurement and management. What are the benefits, and also what have been some of the challenges? And Ruth, I'll actually ask you to kick us off on this topic. The IFC has done a ton of work in this area, and including a lot of work with us on it. And would love to hear your perspective on how you think about these issues.
I don't think you can say you're an impact investor without measuring it. Otherwise, I guess the word greenwashing was used earlier. We can use lots of other terms, and in every investment, you can say, oh, look, there are 6 more blades of grass, right? And we don't want to be going in that direction. We want to be going to what's measurable, what's transparent, what are our intentions? And I'm going to keep using that word because it's a really important word when it comes to impact. But it's your intentions when you go in. It's your intentions how you're doing it, and how are you accomplishing those, and did you get there? So what do? We have a very, very internal, rigorous system where we measure the anticipated impact of each one of our investments up front. And it creates an opportunity for us to get a very good mix of different types of impact in different types of ways. That impact is measured as we go through the investment, and that impact is measured ex ante again, ex post and ex ante. So it's done in both before and after. So measurement is a real part of this. You have to do it. I don't think you can say you're an impact investor, and I know I'm preaching to the choir when I talk to you on that, but I don't think you can say you're an impact investor without that. You have to be able to say, okay, I produced economic returns, right? We all know what an IRR is, and that's really important. We also need to say, you know, how many people did we impact, in what way, what did we do, where did we succeed, and where did we fail? Because by definition, you can be incredibly successful but still not have met certain things. And what is it that we've learned from this investment or from this series of investments that we can do again? So we're very rigorous and very active in that, and we report that out to our investors as well.
Great. Thank you. And David, would love to hear your perspective at ABC World Asia. Have you been thinking about impact measurement and management?
Sure. So our IMM framework, I mean, broadly, is a two-stage process. First, I think we apply the impact screen for all the transaction. I think key thing for us is that in the screen, as Ruth mentioned, you know, there's a couple of criteria. Intentionality is actually a key. It's crucial because we do not want, you know, the business owner to pivot away from impact. The second point is we wanted the linkage between the output of the business and the targeted outcome to be really based on evidence. You know, there must be a so-called the outcome alignment. That's why I think we spend a lot of time constructing our theory, you know, the impact thesis, theory of change, looking at, you know, the both positive and negative externality. We also, you know, examine all the ESG issues facing the company. If the company passes our screen, then it will proceed to the due diligence. And if the financial numbers stack up, then, you know, we will carry out both financial and impact. So during the impact due diligence phase, then we will, you know, do our deep research to validate our impact thesis. So we also look at, you know, how much, what is impact, you know, how much and all that. So that's when we talk to the supplier, customers, you know, from all, you know, from that. Then post due diligence, then we go into stage 2. That's where we, you know, collecting all the data, evaluate. Then we are using the 5 impact dimension by IMP, the how much, what, who, contribution, and risk. So what we did is actually, you know, for each dimension, you know, we give a score, and then we set a hurdle as a passing mark, right? So this is how we, you know, get the impact assessment. At the same time, I think post-investment, of course, we work with a, you know, portfolio company to monitor. Most of our we encourage our portfolio company to actually do a ESG assessment. You know, where are they? You know, hopefully they can actually improve on it, right? So we also understand that in Asia, impact investing is still very nascent. A lot of company needs help. That's how. That's why, you know, at ABC World Asia, we actually set aside a technical assistance budget from the management fee to help the company to further their goal. We help them in terms of, you know, sponsoring the studies, customer survey, even implementing some of the software that monitor the impact KPI. And we also like them to actually, you know, co-invest with us because there's skin in the game, you know. In terms of benefit, I think, you know, we are still a very young organization. There's a lot to learn, right? But I think because we are covering quite a wide range of impact team, so far, I think we have done about, you know, 20 screen, about 10 due diligence. The IMM framework that we designed so far works well for us. But of course, I think when it comes to some of the more specific subsectors, we still need to fine tune. And in particular, you know, venture impact assessment is quite different It's all about conviction. There's a lead of faith, right? So I think we're also working on that framework. We hope to share. Some of the challenges we face is finding, the right research, specifically Asia. Most of the studies are really targeted towards developed country, the US and Europe. It's still applicable, but I think when we come to, because we need to know how much, right? So therefore, I think things are changing. So we also hope to contribute, in this area.
Great.
That's
Thank
how
you.
we look at it.
No, I really appreciate the candor in that. And Andy, I'll come to you next. And can you talk a little bit about, from LeapFrog's experience, what are some of the benefits and challenges of impact measurement and management?
Well, the first deep question is, who are you serving via your companies? And as I mentioned, the first question you should be asking is, are these people who are either low income or excluded in some other way? The second question is, are they getting an essential service? And the third is that service quality, affordable, and relevant? These were all natural ideas when I started LeapFrog, along with some recovering actuaries and CIOs. And we thought these were things that you could check. You could check if an insurance product was quality and affordable and relevant with all sorts of international metrics. So while people had a lot of sense of how vague good intentions could be, in fact, it's proved true, and the GIIN has played a profound role in terms of this, in terms of developing the IRIS metrics and supporting the development of other systems, that you can find highly quantitative as well as qualitative measures of whether companies are having an impact. Now, another crucial thing is whether the impact is actually driving the behavior of the chief executives and management teams. And too often what has happened historically is that the management is incentivized on performance financially, and impact is something that an analyst ticks through at the end of the month or the quarter. It's not a leading indicator, and it's not something to which their compensation is linked. So what LeapFrog did very early on is it created a proprietary system called FIRM, Financial Impact, Innovation, and Risk Management Reporting. And it created that integrated framework looking for metrics that speak to all of those issues. And then it got each subsectoral company to report against that as was relevant to their subsector. And we linked the compensation of many of the management teams to performance against all those metrics, not just financial performance, but areas like risk management and impact. And we really believe that that has allowed us, especially with a 200 million customer data set now, to generate distinctive insights through our CX team and also through the various companies that result in you being able to roll out better products, to drive businesses to achieve higher growth, and to ultimately make those businesses both more sustainable and more appealing to acquirers and the public markets when you IPO.
Okay, thanks for sharing that, Andy. And I do think that is touching upon one of the important themes when it comes to impact measurement and management. Measurement, of course, is the tracking of data and how you kind of measure your progress against metrics. The management piece, I think, is one of the things that Andy's speaking to as well, of how do you integrate that data into the way you manage your portfolio? How does it influence the selection process, the management process, even inform the exit process when we're talking about private equity and in the LeapFrog example? And I think that's a critical thing that we're seeing, is that shift to using impact data to inform investment decision making. Now we're going to pivot to some questions around growth. Our MC teed us up to talk about the growth of the market. The panel is titled The Impact Revolution. So growth, of course, is on our mind and how this goes mainstream. I do want to encourage audience members. I'm still hoping to get in some audience questions, so please use the feed and the platform to post any questions that are on your mind, and I'll try to work those in. But on the topic of growth, we'll actually approach this from a few different dimensions. We'll start off with talking about retail investors. And one of the things that we've seen, and of course represented in the panel, are a lot of the ways institutions are investing directly or investing through intermediaries and partners. But there's also a lot of demand amongst individuals, a groundswell of interest, and there's a lot of data now that surveys people throughout Asia and all around the world that says people want their money aligned with their values. They want it in terms of the way, the products they buy, where they work, but also how they invest. And Benoit, you've been doing some thinking on this topic, and would love to hear kind of your thoughts on the potential and the possibility around retail impact investment.
Well, it's a bit of a red herring question, Amit, but it's a big herring. I think one of your reports suggested that there were about 60 trillion of US dollars of wealth flowing into the millennial investors over the next 3 decades by inheritance and wealth creation. So how much of that 60 trillion of US dollars could flow into impact investing is a real question. So I don't have the answer to your question, but if you look at the travel, the direction of travel effectively, I mean, 15 years ago, as we heard from Ruth, you had the IFC, the foundation, the AFDs, the CDC of this world. So DFIs, foundation, philanthropists investing into impact investing and supporting the LeapFrog of the time. Today, we're seeing more institutional money. You're seeing the likes of Temasek investing into impact. And actually, there is family offices as well. There was recently a debate hosted by IQ-EQ amongst wealth managers and consultants advising family offices. And there was a very clear takeaway, which is they want more opportunities to invest in ESG and impact. There was a very keen appetite from family offices to do that. And actually the keener of this family were the younger one. So the younger generation was extremely keen to put more into impact and ESG. Sometimes they struggle to find the right investment vehicles, but there is a huge pent-up demand for that. So that's for family offices. When it comes to high net worth individual or affluent people, I mean, no later than yesterday, I engaged with one of the platform companies, which is providing access to the PE asset class to high net worth individual and affluent investors. So not quite retail, but you can see the diversification. And this platform in the next 6 months will launch 4 impact products for the first time. So you can see this is continue. I mean, the diversification of capital is there. When it comes to the 60 trillion US dollar question, as you pointed out, I think there is a lot of awareness, a lot of intention from the millennial investors to invest in alignment with their values. I think there was a report issued by EY saying that millennial investors are twice as likely to invest in either funds or corporates who have very clear social or environmental targets. So it's coming. I see 2 derailers or accelerators, depending on how we use them. One is the technology, because you need to have the technology platform to allow the retail investors to flow into or to be exposed to the asset class. And the other thing is risk mitigation. I think it will take very long time and may not quite happen that retail investor do single fund investing because of risk diversification or mitigation issue. And if you allow me to do a bit of a pro bono advertising, here in Singapore, so to speak, we have actually designed a structure to provide access to the PE asset class to retail investor. And when I say retail investor, the average ticket is 12,000 Singapore dollars. And that is Astrea. So every sort of 18 months, we issue a bond, which is taken up by retail and institutional investors in Singapore. And that bond is collateralized by a pool of LP commitment. So, the technique of risk mitigation is there. So you have the awareness, you have the intentionality, you have the capital flowing to the millennial retail investor, and you have the technology and the financing techniques. So I don't know when, but I'm sure it will happen.
No, great, thank you. And I think that starts to talk about this bigger theme around impact at scale. And I want to talk a little bit about the need. Earlier in this week at Ecosperity, a report was released by Temasek and I believe Bain & Company and Microsoft talking about the need for investment in climate solutions just in Southeast Asia over the next 10 years. And the target sum of capital was 2.3 trillion to really for Southeast Asia to meet its part as part of the Paris Climate Accords. So clearly this is a huge scale of capital that we need to mobilize just to address those issues in this region. And we think about this on a global scale and also dimensions of social inclusion. We're talking about really systemic sums of capital. One of the things that we focus on at the GIIN and we talk a lot about is scale with integrity. How do we mobilize more capital to rise to the challenge of the Sustainable Development Goals, but do so with the integrity of impact? And I know that's a topic on the minds of many of our panelists, and I actually want to start with Ruth to talk a little bit about how you're obviously accessing capital at great scale from major investors. How do you think about the opportunity around scale and maintaining the DNA of what's so core to the IFC's work?
So, as you mentioned, the needs are, billions, trillions, however you want to do it, in industries, in regions, in anything that's needed. So I think the financing gap, as people have been talking about over the course of today, and I think the course of the rest of the week, continues and will continue to grow. There is a need for capital to support projects, to support growth across the board. So it's absolutely there. The question is, how do you get that capital to those projects? And it's not just through funds like the three of us manage here. We need to have those projects to be able to attract the capital. And you need a couple of things to do that. You need the regulatory structure within the countries, and that's a really important part of this. You need the entrepreneurs and the businesses there who can work within that, and then you need the third-party capital. So you need to be able to work across the entire ecosystem with companies, with investors, with governments, so that you can structure the economy in a way that can work. I mean, take an obvious, you don't have regulation, you can't have banks. Well, that continues all the way down through lots of things. If you talk about the need for housing in Africa, well, some of the banks can't lend for more than 5 years. If the banks can't lend for more than 5 years, how are housing developers going to develop housing? And then if they can't do that, who's going to provide them with the capital at the same time? So you have a kind of cycle of things that are needed that goes not just from finding the right companies, which I think we all do a good job for, but how do we create the right opportunities that are scalable, and then scalable across different economies, across different sectors there. So I think that's a really important part of this, is thinking about not just pipeline of businesses, but a pipeline of regulation.
Yeah. No, great, thank you for that. And Benoit, I want to turn to you again. We talked about the individual opportunity, retail investors. Obviously, you work at an institutional investor and have been thinking about this issue of how to deploy capital at scale, both for Temasek, but also as you engage with your peers all around the world. So can you speak from your vantage point how you think about this issue?
Well, first of all, I agree with Ruth. I think we don't have the luxury of keeping impact investing as an asset class like a cottage industry. I mean, given the need and the funding gap, it has to grow. So no one is trying to prevent that asset class from growing. And if you look at, part of my job is to invest in private equity fund, and I look at the top 7 large asset managers in private equity, and look at what they've done over the last 12 months in the impact AUM. They raised collectively $17 billion for impact commitment, and thereby quadrupling the AUM in impact, quadrupling within 12 months. So there is indeed a fantastic growth, and some would say uncontrollable growth, but it's needed, right? Every initiative in addressing the financing or the funding gap to address the SDGs, I think, is welcome. But while the risks are obvious, right? You have greenwashing is an obvious one. I don't want to belabor that point, but that's one. Another one is mission creep or size creep. And we're seeing that in our traditional private equity funds. When you outgrow your skill set, well, then there is a risk. So that is something we will be quite focused on. And I think there is another risk, which from an investment perspective is very real, and that's asset inflation. We see that, for example, in ESG. You in the public markets, sometimes you have an ESG premium, which is hard to justify in terms of fundamental valuation. And there is a risk in impact investing that you build a sort of impact premium a bit artificially, that eventually you will have to pay. And I think that's a risk we are also very mindful of. I think Ruth said it. At the end of the day, much will depend on two things. One is the integrity of the GPs, the intentionality, the authenticity, the transparency of the GP, and the other thing is the engagement model. And I think David mentioned it. I think and the good thing is the engagement model of private equity is very virtuous, as I've experienced it over the last 21 years. You're here to change. You want to drive or affect changes, and those impact investor who will just sort of collect, report KPIs which were there, sort of buried, and they just report them, that will not work. You have to have the intention and the ability to drive changes. And again, the good thing is the very DNA of private equity as an engagement model is to effect changes. So I think I share the concerns, but I'm actually pretty optimistic because of the way PE and private equity works.
Great, thank you. And the last topic around growth that I want to touch upon is around the role of technology. And how technology is playing a role in enhancing impact, and also if there are any issues or risks you see with the way that technology is being used in the impact investment landscape. David, we'll start with you. I know many of the businesses you're investing in have technology as the main component of their business models. So could you speak to the role of tech in accelerating the growth of impact investing?
Sure, I think tech is a very powerful, enabler. I guess the bigger question is that, is the business owner using tech to actually, provide solution to the underserved and tackling some of the environmental issues. In today's world, there are probably more Fitbit devices, tracking your fitness rather than devices tracking the chronic illness. But I think things are changing. It's quite encouraging because smartphones are getting cheaper, data pricing is also getting more affordable. But from our own experience, I think so far we invested 6, going to be 7. All our portfolio company, they actually harness tech. Tech is actually quite central to their business model. They use tech to increase accessibility. They use tech to scale, otherwise they wouldn't. And they also use tech to increase efficiency. I think more importantly, I think they also use tech to think about how to innovate and then try to be more creative. So that's all good, right? But I think during the last 1.5 years, I think the COVID-19 pandemic also revealed a big digital divide. In Asia, I think we are a digitally disadvantaged region, right? There's still a huge population which is not connected. Yeah, so I think that's why I think for us, I think digital, accessibility and digital literacy, is equally important. You need to also teach the underserved group to how to harness the power of technology. That's why I think for us at ABC World Asia, in the very beginning, digital inclusion is one of our impact investment team. So, but I'm optimistic. Things are looking up. I think tech will be a very powerful tool. Tech will be helping us in terms of data collecting, will be more accurate. So I'm fairly optimistic.
Great, thank you. And Andy, I want to bring your perspective in as well. Obviously, technology has played a very instrumental role for many of the companies that you work with. Can you speak a little bit to its role in financial inclusion and more broadly in impact investing?
Absolutely, and I just want to say how powerful those points from David were about the different uses of technology and the significance of digital inclusion for driving all sorts of other forms of inclusion. The reality is that the low-tech or no-tech players have often been serving low-income people to the extent that they have been serving them fairly badly. So a good example would be in the remittances space, which of course is such a significant space for Asia and indeed for Singapore. There you've had legacy players charging people sometimes 9 or 10 or 15% to remit their money home if they're a migrant to their country of origin. And that's frankly outrageous. So if you look at companies that have risen to fight that, there are these digital disruptors, for example, Zeps or WorldRemit, our portfolio company, that said, well, let's just go straight to digital, and instead of charging people 10%, let's charge them amounts like, say, 2% to remit their capital. And it's meant hugely greater disposable income for people on the other side, the families, the grandmothers, the daughters, the children, the parents, and anything that they need that capital for. Now, WorldRemit has just had an investment that valued it at $5 billion. So it is an impact quinty unicorn. And you can see that this kind of serving of millions and millions of people with a far better service due to digital can be not only very highly impactful, but very value accretive. And if we zoom out and we look at other areas such as healthcare and education, which have been mentioned tonight, you can see tech disrupting these spaces quite fundamentally and in all sorts of ways, not just with distribution. So for example, MedGenome, a LeapFrog company that also the IFC has now invested in, is using genetic diagnostic testing to assess people's risk of severe COVID, of cardiovascular disease, of diabetes, etc., and help develop precision solutions to those problems, not just for the developed world, but especially for the developing world. Right now, so much of the testing that is happening is happening in the developed world, and it's really crucial that there be other companies like MedGenome, which is now the largest non-developed world, developing world genetic diagnostics company. It's really crucial that more and more of these kind of innovations are introduced, because once we have the diagnostics, we can start distributing some of the solutions with tech as well.
Great, thank you. And I think we're actually going to turn to audience questions, but we have one that is actually focused on technology. And what I'll do for the panelists is just, since some of these are very targeted questions, just ask to kind of like give me a nod or raise a hand if you have something to comment on with this. But Alan Hanhui Teo has asked a question about technology and climate solutions. And in particular, I'll read his question. Hardware tech will play a key part in climate solutions, but investors are moving away from hardware to preferring digital and software businesses due to the potential for higher returns. What are your thoughts on this? Just turn to the panelists. If anyone can speak to the appeal of hardware-based technology versus like software-based technology. Any takers? All right, Andy.
I would just say, not necessarily with respect to climate, but more broadly, there have often been thought to be asset-heavy solutions to things that should be asset-light solutions. So, for example, dealing with healthcare in Africa, one of the most challenging issues for many Africans is how many of them fall into poverty because of health events. And I've seen this myself. I'm from South Africa and worked across the continent. And if you think about the solutions that are needed, instead of rolling out big hospitals, often what's needed is insurance that can be distributed lightly. It's technology systems that allow for people to track their medications. It's systems that enable the rollout of different supply chains so that you can have many pharmacies develop, such as our company Good Life Pharmacies in Kenya. So I think the idea that there's just either software or hardware is not necessarily correct. I think the idea that we now need to mobilize these digital technologies to make the hardware pieces work better and to make the heavy assets work better is an important one. And where we can leapfrog over the legacy systems that have kept the West much more tied to hardware, we really should. And that includes both in the social impact space and in the climate space.
Great. Thanks, Andy. Benoit, were you trying to get in on this question as well?
Yeah, look, I'm not an expert, but if you think, if you look at the business model of some of the digital payment enablers and the way they've grown their business in Europe by effectively providing the hardware for free and making that up with the take rate they're taking on the transaction. I think if you were to apply the same business model to developing countries and offering the hardware, I think that the business model will not work. So I don't have the answer to the question, but clearly the way these businesses have grown into developed countries, you can't really copy paste and apply this to emerging markets in the same way, because effectively your take rate will never be able, because of the lower transaction values, you will not be able to recoup that hardware cost. So you have to think about different ways of financing the hardware, and that probably means that you have financing schemes to be designed so that you can pump the payment ecosystem by providing some sort of affordable hardware so that you can leverage the payment ecosystem.
Great, thank you. And now we'll move to one other audience question before we close out. And this is a question from Sarah Clausen, a topic that's actually comes up often. How do you view the role of blended finance structures in catalyzing impact investment? And is that a useful way of getting commercial investors to commit capital alongside the way that she terms it as impact investors? I would actually characterize it slightly differently of those providers of catalytic capital. So investors who have more flexibility in terms of the structures they can use. I know that a number of you are touching upon this. So is this something that you'd great. So turn to Ruth, and I know the IFC has done a lot of work in blended finance.
Right. So we do a lot of blended finance, and blended finance is really important to bring people into places where they haven't gone before, or where the risk reward is really slightly off. And it's very important in catalyzing. Sorry, I'm using another one of your words, but catalyzing people to get there. And blended finance is also really important because it provides a demonstration effect that there is a way to make money. Providing blended finance for equity investing is an interesting debate because you're at the bottom of the capital structure by definition, and how much protection can you have? So the way we look at it is potentially you can look at blended finance higher up in the capital structure. And if a company is in a certain situation where, I mean, I'll use the hardware example that was just given there, which is very difficult to finance, is there a way to get that with blended finance to help support? On the equity side, looking at things like first losses in equity, it's lovely if you're an investor, but it's a very difficult way to do this. And also, what kind of risk are you taking as an equity investor there? So I think that the importance here is demonstration effect. And I think there's another way of thinking about blended finance, which isn't directly blended finance, which is organizations like IFC and other DFIs go into situations that maybe other investors aren't willing to do. They'll go in, they'll take equity, and then they'll be successful. And you can look at those early forays into going into these companies as a demonstration effect to show that there's a way to get there, there's a way to do it, and there's a way to do it successfully as well. So not your traditional blended finance, but I think another way of looking at it.
Great, thank you. And now I want to thank the audience for submitting this question. So thank you, Alan and Sarah, for those thoughtful questions. And we'll turn to actually a closing question for this session before we have a video from one of our remote participants. So there's so much about Ecosperity that's looking to the future, and I thought Benoit spoke quite eloquently to that in his his early remarks about investing for the future, and how do we make those decisions today that lead to a more sustainable future. As one of the big themes, of course, around the global agenda is anchoring around the year 2030. This, of course, is the target for the UN Sustainable Development Goals. It's also the target for the Paris Climate Accords. And I want to ask each of our panelists, as we think about the vision for the future of impact investing, and if we could fast forward to 2030, what do you think the market looks like? What would you like to see at that point? And we have about time for about a minute apiece. And so I will kick off with our folks who are participating remotely. And so Benoit, maybe you can lead us off with that, your thoughts on that question.
Thanks, Amir. I mean, you remember the 7 asset managers I mentioned and the fact they quadrupled their AUM in impact over the last 12 months. And yet, if you look at the stock that is less than 2% of their total AUM. If I take my little allocation, so to speak, in impact investing for the next 5 years, and I compare it to the average investment pace of Temasek as a whole, it's less than 1%. So we have a lot of way to grow. And I think the good thing, what I'm hearing from the panel, is everyone is very much aware of the risk and very much aware of the opportunities. What it means is we are really going there with our eyes very much open, and very optimistic as to where it has to grow. It has to grow. There is no other choice that growing this. I think by 2030, we will see more sort of different pockets of capital flowing into the space, and I mentioned the retail. I think by 2030, my role will be totally redundant, because effectively impact investing would have, if I look at Temasek, would have sort of percolated across the markets and sectors, and the strategy of impact investing will actually be owned by the various sectors and markets, and I think it will effectively be a very infectious way of investing.
Great, thank you, Benoit. I love that kind of vision of how impact just becomes embedded in the various strategies and teams throughout the firm. And Andy, I'll turn to you. Where do you see impact investing in 2030?
Well, LeapFrog has already committed to reaching 1 billion people by the end of the decade, low-income people with essential services. And my hope is that if we can even think about that as one firm, that the hundreds of allocators and investors and managers out there can collectively reach those 4 billion low-income people with essential services through their companies. That's, I guess, my first and greatest hope, because that would be historically unprecedented, to take half of humanity and get them the services they need to have agency and well-being. For impact investing itself, I think Benoit is absolutely right. The aim is to have this integrated throughout the system. The big risk is that impact gets defined by those who are effective at asset gathering, but are offering impact light. And I think the panelists tonight are standing exemplars, David, Ruth, Benoit, of people who are intent on doing impact with authenticity and with integrity. And I think there's a profound role for those exemplars in terms of demonstrating how to do impact right. And my hope is that by 2030, those people will have defined this multi-tens of trillions of dollar field more profoundly, such that the standards are high and the audits are checking that the impacts are deep, not just wide.
Great, thanks, Andy. And I really appreciate those themes of the authenticity and the integrity will be critical to making markets work for everyone. And that inclusive vision, I think, is incredibly powerful. Ruth, we'll turn to you next. What's your vision?
So I think that the fact that impact becomes integrated is absolutely critical. And we can see that evidenced 2 years ago, IFC launched Principles for Impact Investing. The initial group of signatories was in the 30s. We're at 142 signatories from 33 countries, representing over 400 billion of assets, either under management or advisement along those lines. That's a pretty nice IRR in 2 years. And I think shows that there is a group of people out there who want to be accountable and reasonable. And so I think this is an opportunity to continue doing impact investing and to focus on it the right ways. And I'd like to kind of re-roll this tape in 9 years in 2030, and we'll see what happens.
Yeah. All right, I appreciate that point. And I really like how you also brought in the dimension, not just of IFC as an investor, but also helping to foster the ecosystem that will get us to that type of scale. David, over to you to bring us home.
Okay, where we are, where will we be in 2030 in Asia? Well, if you look at where we are now in Asia, I think Benoit said that the allocation to impact investing, my best guess is a low single digit, right? It's my hope that I think 2030, I think probably, I hope at least 25%. I'm quite optimistic because I think because a couple of reasons. I think the younger generation in Asia is quite vocal about social injustice. They're quite passionate about environmental challenges. So it's the same group of young people. They are consumer as well as a future capital allocator. Because in Asia, you may be aware, it's one of the fastest in terms of wealth accumulation. So in 9 years' time, they will be a business owner. There will be a capital allocator. There will be a great wealth transfer. I'm very hopeful that this group of young people will allocate more to impact investing. But I think most important is really the IMM, the impact measurement and management. Is always, to me, that is a big hurdle for impact investing. But I'm optimistic because I think GIIN is working with IMP. A lot of collaborative effort. And if you look at it, I think there'll be more success story coming out of Asia. There'll be more people sharing. So I think it's all in the. I'm quite optimistic we will get there.
Great, thank you. No, thank you so much, and I appreciate that tone of optimism and also the focus on integrity, fueling that optimism that came through from all the panelists. And now we'll bring this panel to a close, and I do want to thank all our panelists for sharing, well, first for their leadership and for the work that they do day in and day out to help build this market and to help work with organizations like the GIIN to build the ecosystem. But as a final thought, I think one thing that I think is so powerful coming through the entire agenda at Ecosperity is the kind of the importance of this moment and the significance that with the big challenges the world is facing around climate change, around kind of ecosystem collapse and loss of nature, as well as social exclusion and instability. This is a time that when it comes to impact, we cannot afford for capital to underperform. And on this panel, you've heard many of the leaders who are helping to define the way we can drive a new way of investing and a new way of thinking that hopefully does become integrated into the way the markets operate. Now, to close out this session, we are really thrilled to have some words. We'll have a video from Sir Ronald Cohen, who's been certainly a leader and an advocate in the impact investing movement, and also a fellow traveler and colleague in helping to build out the market. And so we'll cue a video and hear Sir Ronald Cohen's thoughts on what it will take to drive an impact revolution. Thank you.
It's a great pleasure to join you all at this Sustainable Investing and Financing Conference organized by Temasek, BlackRock, and IFC. And I would like to direct my comments today to the future of the impact revolution. I see three major forces driving an improvement in our world. The first is a massive change in values, which started with young people who refused to purchase the products of companies that were doing harm, either climatically or socially, through the employment of child labor and so on. The same young people refused to work for these companies, and as I see it, this led investors to become aware that there were serious implications for the profitability of their investment portfolios. And investors themselves saw a change of values, with great pressure coming to align investment with the values of the clients of asset management firms, and in the case of pension funds, with the values of savers. So there's a massive change in values. It's driving $40 trillion of ESG money today to achieve profit and impact. And it isn't a flash in the pan. It's too big to be that. It's more than half of all professionally managed assets in the world. The second massive force is leaps in technology, which through artificial intelligence, machine learning, augmented reality, the genome and powerful computing coming together are enabling us to deliver impact to improve the world in ways humanity could never previously contemplate. And the third major force is through technology and big data, our ability to measure the impacts of companies in a granular way, measuring their operating impact on the environment, their employment impact on people, their product impact on people and the environment, and turning it into monetary values that can be compared between environmental and social impact with profit. These three major forces are going to cause a disruption in investing and in the way that business is carried out, akin to the disruption that we saw the tech revolution bring. And the impact revolution will build on the tech revolution as entrepreneurs begin to develop impact business models that combine a value creation model with the delivery of impact, so that the more impact a company delivers, the greater the profit that it generates. And this optimization of risk-return impact will take investment to a new efficient investment frontier that is going to be more favorable in financial terms than the optimization of simply risk and return. Because introducing impact into a business model today means that it is easier to attract customers, to attract talent, to attract investors, and at the same time helps the company to avoid the risks of regulation and taxation, such as the carbon tax, which is increasingly talked about. Now, what's going to drive this revolution? Entrepreneurs are going to cause the disruption. We see what Tesla has done in the automobile industry. It didn't pick the automobile industry as an easy place to make money. It picked the automobile industry partly because it felt that its technology could shift the industry away from the polluting combustion engine. And I am seeing exciting business models from entrepreneurs right across the world that bring impact to the core of their business model in fields like education and health and fintech and clean energy. In fact, every area of business activity is going to be disrupted by impact in the same way that technology previously disrupted them. And so when we look at the impact revolution today, we realize that it is being driven by necessity, the necessity to tackle our climate and social problems through our economic system, through businesses and investors, so that our system ceases to create and aggravate social and climatic problems and begins to bring solutions to them. Looking ahead, we will see the impact ventures that improve the lives of 1 billion people. We will see the Steve Jobses and the Bill Gates of impact venturing. And our opportunity today is to get government to drive the transparency on the impacts of companies so that we can create a race to the top by giving investors, in particular, the ability to make informed decisions about which companies are doing good and doing well at the same time, and therefore have the prospect of the greatest growth and the greatest value creation. Adam Smith's famous invisible hand of markets is no longer sufficient to take people out of poverty and to deal with our social issues. We now have to bring impact to the center of our economic system, to bring the invisible heart of markets to guide their invisible hand.
Thank you very much, Sir Ronald Cohen, and thank you to our panelists. We really appreciate that, and to Mr. Bouri for really framing that conversation. I think there was so much food for thought here, and we're hoping that this conversation doesn't end here. This is the time to really connect, and as was mentioned in the panel, this is a relatively new and nascent approach here in this part of the world, so that means there's a lot of opportunities that are ripe, so please let's continue this conversation. We do actually have an hour where we can do that, and hopefully beyond that as well, whether it be live on our platform or here in the room amongst us. So those of you joining us on EcoSpare